Hello, this is Derek Iswell, Chief Investment Officer for Shelton Capital Management with the Shelton Capital CIO Minute. In China last week, China held their 5-yearly Congress where, as expected, Xi Jinping solidified his hold on the party and the leadership of the country. Equity markets in China reacted negatively once the Congress had concluded, declining anywhere from 5 to 10%, depending on which exchange or sector you looked at. This market action is a continuation of a steady market decline in Chinese equities since February of 2021. And since then, the market is off some 40 to 50%. The list of troubling developments contributing to this market sell-off is long. This consolidation of power is one of the issues. Going along with it has been a clampdown on some of the business leaders in China who are viewed to potentially oppose the government. On top of that, there's been financial distress in the real estate sector and a restrictive COVID policy where rolling lockdowns from city to city have restricted economic behavior and raised some concerns about the supply chain. Now, facts to keep in mind about the Chinese equity market weakness is that emerging markets in general have been weak over the same period. Not quite the same amount, but still a lot of those markets have been down close to 30 or 40%. Also keep in mind that long-term fundamentals in China are also still very challenging. Economic growth has been slowing steadily over the last few years, and their population demographics are some of the worst in the world. So investors underweight China might be tempted to close some or all of that position given the recent sell-off, but an overweight to Chinese stock markets in the long term remains risky. Thanks for checking in, and this has been a Shelton Capital CIO.